Rob.
Hey, Kyle.
Welcome back.
I appreciate it. It's always great to catch up and discuss markets.
Yeah, love it. Looking forward to today. We're going to spend some time talking about what 2025 taught us and, what might be in store here for 2026.
Yep, let's do it.
There's always a lot to unpack. We're going to talk about interest rates, AI-driven markets, the labor picture, gold, the dollar, kind of bounce around and hit a number of things. But
all the very impactful themes from the last year.
Exactly. I think we have learned a lot. And, and some of the most important lessons aren't always found in the headlines. At the start of 2025, if we go back, I can't believe this year has just flown by.
They get faster and faster every year.
I think that comes with, as we were talking about earlier before we jumped on, just chasing kids.
Exactly.
Yeah. They're ready for Christmas again. So at the start of this year, most people expected that the Fed would be more aggressive with, rate cuts. Tell us a little bit about maybe why didn't that happen and inflation's been maybe a little stickier than expected.
It's a good question. I think going back a year, you have to go back to why would the Fed even cut rates, and that's usually just because of this massive softening in the labor market, and we really didn't get that at least until recently. So the Fed, I don't think, had as much of a reason to cut. That in conjunction with the other part of their dual mandate, which is keeping inflation low, we didn't really see inflation go as low as I think many had expected. Again, they have that 2% target, which we'll talk about it, is probably a bit dubious. Mm-hmm. And there was a lot of tariff talk and cloudiness in there that I think influenced a lot of reality versus forecasts.
You and I haven't talked about it much, but I think that 2% target, that's a tough target.
I think it's a tough target. I agree. And I think everyone's looking at it with a little bit of recency bias. When you go all the way back to the mid-1950s with some of the Federal Reserve data, inflation's really been closer to 3%.
Right.
So looking after the Great Recession, and there are a lot of reasons why we now know inflation wasn't generated from that stimulus, it's hard to believe that going forward that inflation's going to be as low as it was.
Inflation really comes down to, a lot of it is, the supply of money that's out there, M2, that's not being pulled back.
No.
There's nothing that's being, that's really happening on that end. So I think that 2%, target
it might get there.
It might get there. I also want a 6-pack. I don't know that I'm going to get there.
Right.
Am I happy with a 2-pack?
Maybe we'll just settle for it.
Yeah, we'll just settle for that. 3% I think is a more realistic goal.
Historically, it is.
Yeah, and it would probably help in the headlines a little bit, but we'll see where that ends up settling. But it's hanging at that 3, and we're probably going to see more of that heading into 2026.
I would think so, especially with what's influencing inflation. Right. Again, we have a fairly large issue with regards to the supply of housing. So when you look at inflation related to where people are living, I don't know if that's necessarily going to go down. And then you have to go, I guess, look at what you really can't control, which is the difference between headline inflation and core inflation, and that's food prices, which we have all experienced the massive price increases there, and then that wild card that is energy.
One of the things I think we really benefited from, our clients, truly benefited from this year, was the surge in the market.
Yes.
Up 16%.
Our jobs are always much more fun when markets go in one direction.
Yeah. Sleep a little better at night, and overall, knock on wood, it's been pretty good. We had obviously some volatility in Q2 with tariffs in the headlines every second. But what drove the market this year? Why is it up double digits? And what's your take on that?
I think a lot of it has to do with earnings and what we always like to refer to as the top right side of the style box and technology and communication services names with AI spend. Now that those names comprise close to, I think the top 5 companies in the S&P 500, that's almost a quarter of the index now. And
right.
I think large cap growth is 40% of the index. So that's a meaningful weight to these companies. And as more and more money flows that direction, the entire index is going to pull that way.
Do you think, and we've talked about it a little bit in the past, do we think we're going to see, a broadening of the market more towards smaller mids? I mean, international, had a nice little surprise this year.
Yes, it did.
Which was great. But any thought on the small and mid caps?
I would like to think we would have a broadening out, but every time I think we're getting there, I'm always wrong. So I'm a little hesitant to say so. I think, and we can jump in this more towards our conclusion and what we think going forward, but I'm a big fan of thematic diversification going forward. International, I'll be honest, this is one of the first time in my professional career where I've seen that area of the market work, especially for U.S.-based investors, and that's nice to see. A lot of that was due to dollar weakness, but I think what's causing money flows going more towards international developed should continue for the foreseeable future. So it's looking like, knock on wood, markets might be broadening out, which, again, everyone's looking for this AI trade to collapse on itself. Maybe it doesn't have to collapse. I think it's still going to be there. But if people are selling out of market winners, they have to put that money somewhere. So they would naturally rotate into something else, which would support a broadening out.
And where's it going to go? One of the things, when I was getting going in my career 30 years ago, that's back when AOL and Yahoo and all these companies were coming out. And they had no earnings.
Yep.
We've talked about that in the past. And since we kind of opened the door to the AI side, is it hype? Is it something that's actually transformational, that has a foundation to build upon with earnings with these companies? And we're seeing circular movement of money too. So we've got to take that into account.
I think that's, talking about your experience, that's caught a lot of people like yourself a bit off guard, because it's not necessarily to say that it's deja vu exactly, but wait a minute, I've seen this, and maybe I can be a bit skeptical.
Yeah.
I think it's a bit of both. I do think what we're seeing now in the AI space, granted, I'm not a technologist at heart, but I think there are some differences here. One, what we're seeing with transformers does have the ability to really increase productivity and maybe vastly change the way we go about how we work and what we do with our personal lives. Then there's artificial general intelligence, where you start talking about self-prompting. I still think we're a bit of a ways away there. That being said, I don't think this money flow into AI is going to stop anytime soon. But and this is maybe a bit of a corollary to what people are thinking with private credit. When you get such a rush of capital going into the same parts of the market, there are bound to be inefficiencies. And I think that's what it's giving people pause right now. But overall, I expect this trade to continue.
Yeah. There are strong fundamentals. There's a lot of, I think you're hitting on it there, crowding risk. A lot of people have jumped into that space. A lot of overexuberance.
Yes.
Which when we, fundamentally, as an investor, as a money manager, when we see that overexuberance, now I think we start questioning where are we at in the market cycle.
Yep.
And is there going to be that bubble? And is it a small one? Is it a big pullback? Those are all things that, we're looking for down the road here.
I thought what we talked about as a team a while ago is pretty apt to this conversation. Technology, and when you get most technology researchers to talk about it, big, massive shifts tend to be a bit over-exaggerated in the short run and a bit underappreciated in the long run. I think the options trade is called a calendar spread there, but I digress. Basically, what we had factored in is the amount of money, trillions of dollars flowing into the space. If you look at that CapEx spend and what investors would anticipate being the result in the near future, equates to 3 Microsofts.
Wow.
Which is almost 800 or 900 billion in revenue in relatively short order. So when you think about, is that actually going to come to fruition in the next 18 months? We're a solid 2.5 years into this AI boom. I just don't know.
Right.
Could you convince me that that's going to happen over the next 10 years? Yes, absolutely. I don't know when it's all going to happen.
Sure.
So again, that's what's giving people pause.
We've got a front row seat.
We got a front row seat to it. It's going to be fun.
Yeah. Yep. You mentioned cracks in the labor market.
Yep.
What are maybe we seen or not seen under the surface? What's behind a little bit of that, where we're starting to see it move a little bit?
Great question. And it's interesting that we're doing this podcast after the Fed announcement yesterday, in which they agreed to lower their target rate by another 25 basis points. I think Powell was very transparent in his commentary when he stated that when you look at labor market data, it's very much survey based. So it's going going to swing, and it's going to be a bit variable. So it's never necessarily the initial reading that people need to pay attention to. It's often the second and third and final readings. I think pulling back the layers, we've heard that the labor market is solid. I don't know if that's necessarily true. I think what happened was job openings stopped, or I should say evaporated first, and now we're hearing of people are not necessarily being laid off, although we are hearing public companies through their earnings announce kind of a labor reduction, if you will. So it is out there. Now you're also not getting people hiring either. And then now also on top of that, if you don't necessarily know what labor demand is, we're in this interesting phase where we actually don't even know what labor supply, what that denominator is either. So while the headline rate, which is what's always quoted, that's always going to be based on people that are actively looking for work. But if you look at the amount of population that is maybe discouraged or underemployed, that's actually a much bigger denominator. And that rate's been steadily creeping up over the last years. So I always look at that U6 rate as our labor market participants as strong, or are they participating in the market? And I would just argue that maybe things are just a bit softer than what we are meant to believe, but also, short story long, all that data is retrospective. You really don't know in the moment.
Right. It's really tough to calculate all that, and I think as we see it move along, we're seeing some softening, and we'll see how it all plays out.
Yes.
So this year, you mentioned earlier the dollar, gold has been a
What
sector
a story.
Right. How that's taken off. We've seen major moves in the dollar and gold this year. What's going on that end? Is gold overpriced? Is it, and that's not an area that, maybe hit on the EdgeRock philosophy with gold a little bit, but diversification, we're seeing AI, how that's taken off, gold has taken off. There's always that fear of missing out. But how should we be allocating as we, continue into the conversation further?
It's a really good question. You and I have talked about it. I don't think either one of us is necessarily a gold bug.
No.
That being said, there are a lot of very
I'm not buying gold at 3 a.m. I'm not watching the commercials, so.
I just don't think that's where our experience has led us. That being said, there are many smart men and women and groups out there that have, if you go back and look at their commentary, have told everyone to start paying attention to this asset class. And when you go through in hindsight and read what are the reasons that would potentially drive a rise in gold, it would be dollar weakening. Well, check, we've seen that.
Right.
Sovereigns start buying again. Yes, I think there's been a lot of evidence out there that in commentary that yes, China and Russia are buying a lot of gold, which is going to leave institutional buyers. It's a momentum trade at this point.
Yep.
Institutional buyers are in, and then you get this retail buyer in there. As far as valuations, I don't know. That's a hard asset class to really price.
There's no earnings.
There's no earnings. It's been a bit of a risk hedge going back in markets. And when you look at broad top-down diversification strategies, there's always an area and room in portfolios for commodities. Sure. And when we start talking about broadening out, we've been so concentrated with this US-based tech AI trade since, it's probably been 15 years where you've really only had to own the S&P 500 and that's about it. Maybe we are going back to a period of market history where a bit of a diversification works. And what I always like to tell our clients and people are the facts and circumstances that have caused gold's rise, will they persist in the near-term future? Yeah, I don't think it's a reason to be overweight in the commodities, but it's certainly a reason to own them.
Sure. Yeah, I think.
Do you have to? Maybe not.
Yeah, it's not necessarily a bad thing to own a little bit there, But that again, the diversification piece, across the board. We talk about that all the time. Being properly diversified is a great hedge against whatever might happen in the market.
Exactly. I always like to tell people if everything in your portfolio is moving up all at the same time, are you really diversified?
Right.
No.
Yeah, something to keep an eye on. Looking ahead, 2026. What's kind of your base case for the market, and the economy ahead? What do we think is just a base outlook moving forward?
I don't think it's necessarily original. I think it's probably pretty consensus with markets being as pricey as they are, it's hard to think about multiple expansion where you get any sort of market multiple go from, if we just take price earnings from 22 to 30, right? Then I really do think bubble alarms are going to start ringing. So it's hard for me to say that that's probably going to happen. I think what's most likely is markets will follow earnings, right? So as long as earnings are positive and those passive fund flows keep flowing into markets, yeah, I think the path of least resistance in domestic equity markets is likely up. I don't know if it's going to be a 20% year. I would probably argue no, but is it reasonable to get something mid-single to low doubles? Sure.
Yeah, it's not unrealistic. It could also swing back, and be the opposite.
Sure, we could get another tariff-like announcement in the middle of the year that might
Sure.
throw a wrench in things. But I mean, you look at where we are from the beginning of 2025 to where we are now.
Yeah.
Yeah, good years.
Yeah. So maybe inflation still hanging around that 3% area. The market, probably certainly one of the top indicators, if not the top, is earnings. Continuing to watch that. With that, I think an important piece here as we move forward is, we never say that we have we never profess to have a crystal ball.
Wish we did.
Right. Yep. We'd be taking a look at that 24/7.
100%.
But proper portfolio, right? The right diversification, and working to hopefully, as an investor, you have to be careful about that exuberance, that we don't get too excited, and have maybe too many of our eggs in that, that top. Again, you hit on it there. If you own the S&P 500, if you just buy that index alone, 25% of your money is in the top couple of stocks.
Yes.
So you have to be very careful because you're over concentrated potentially in that area.
You're as concentrated as I've ever seen it.
Right, big time. And so having some other areas in the portfolio, what might be a couple of other outside areas when we're looking at just private investments that would help to diversify that portfolio a little bit?
Yes, I think this is where we as a firm have started to believe very much in thematic diversification, not necessarily the textbook growth versus value, but if we could steal from a popular podcast out there, is the All In podcast. It's phenomenal. I love listening to it.
I listen to it every Friday, Saturday.
I think to kind of steal their message, you have this gigantic elephant in the room, which is AI, and anything that's going to be AI enabled, there are going to be winners there. Yes, there are going to be some losers too, but I think it makes sense to own it. I think for most clients, you have plenty of exposure just through the S&P 500. So you think of, well, what's going to offset that risk, which is the S&P 500? You think about what AI can't reasonably do in the foreseeable future, and that's in the ownership and movement of just atoms, right? So when you think about, well, what is maybe the antithesis of AI right now, I think real estate is very interesting since it's essentially come out of its own recession.
Right.
And everyone sort of applies this blanket statement to real estate, which is class B and C office, which couldn't be further from the truth. I think private real estate is very interesting. I think private infrastructure is very interesting because when you look at the infrastructure needs over the next 10 years in all developed economies, I don't think they're getting as much capital as they really need. So I think that is a recipe for some pretty good risk-adjusted returns there. So again, AI and then just
what's the opposite?
What's the opposite?
Right.
I think that's a great way to diversify your portfolio right now. And that's not necessarily, I don't love talking return expectations, but
Right.
I think maybe infrastructure and private real estate, it's the old case of buying low. A lot of the risk there is just hedged by the fact that entry points there are relatively attractive.
Right. I couldn't agree more. And if we're taking the approach of a disciplined, diversified, data-driven investor, then those areas make sense, right?
I agree. And even the S&P 500 right now and the risks that are there, and I think the risks that are not necessarily becoming more tangible, but more seen, it's hard to play a timing game there. I can't ever tell you to not own the S&P 500 because frankly, I will always own the S&P 500. It's been a phenomenal investment. since inception.
Right.
It will most likely continue to be a good part of your portfolio, but at least now, like, there's some interesting other ideas out there.
Yeah. I mean, you're betting on the U.S. economy. You're betting on the U.S. entrepreneur.
Yeah.
People going, trying to, striving for their goals and working as hard as they can. And that's what you're betting on and what this country allows.
And I think on a previous podcast, you had even mentioned when you started your career, what were the best companies in the S&P 500? Completely different. Which one was?
Right. I mean, you have IBM, you have GE, companies that we don't even talk about any longer.
It's a self-correcting mechanism, market cap weighted index. No matter what the next 5 or 10 years look like, it's hard to argue against it. And not a big fan of market timing, so you might as well just own it.
That's exactly right. Yeah. Own it. Have the right portfolio that's diversified. Yeah. Take advantage of those ups and downs. We're coming into the end of the year. Little things that people can do with tax loss harvesting. That's something that we've been doing a lot of. I know you and our team, the investment team, have been spending a lot of time on that end. Maybe hit on that for a moment.
Yeah. So a lot of people look at it as this year-end exercise, which doing it at the year-end is better than not doing it at all. But throughout the year, we'll use bouts of volatility to try to do it. So we were doing it in April. We were doing it last month, for example. We're doing it this month. Anytime we see an opportunity to do it, we'll do it. And again, it's just because we manage money mostly for families, which are after-tax investors. It's really your after-tax return that means everything. The most, everything for you. Yeah. So we might as well try to be pretty aggressive about it. It's low-hanging fruit, right?
Right. That's the key. You hit on it right there. As important as anything that we said today, I think, what is your after-tax return? And when, there are 240 trading days throughout the year that the market's open. Yeah. And I think a good advisor, and I say that loosely, maybe does tax loss harvesting one day out of that 240, whereas this is something we're looking at often and doing all throughout the year, being opportunistic. And, this is just another time of year to be opportunistic. We're coming up on the end of year deadline, so another time to do it. So
that, along with the forward-looking tax planning Roth conversion scenarios that our advisors are doing, controlling what you're controlling and trying to derive some tax alpha goes a long way, because as you and I talk about, you can't control markets. No,
you can't. But you can make, I think, wise decisions in the long run based on the data that we have. And let's reduce that family's long-term lifetime tax and the heirs that might inherit that money. Oftentimes we can wipe out the tax bill that they're going to have. So it's just being thoughtful.
Pretty powerful legacy tools there.
Right. Kids should be happy.
Yeah, I think a little underappreciated sometimes. Yeah, but yes.
That's all right. Yeah, we love what we do every day. So, hey, for a deeper dive into portfolios or anything, reach out to EdgeRock. Go to edgerockwealth.com. And, looking forward to doing this again, starting off early in the year in 2026. And we'll have another discussion. And
should be an interesting ride.
Yeah.
I'm going to be pretty disappointed if it's not.
It always is. So, hang on, buckle up, and it'll be a great year.
Yep.
All right. Thanks again for everything you've done this year, Rob.
Yeah, likewise, Kyle. Really love working here. Love working on behalf of our clients. Happy holidays.
Yeah, you too.
Catch up in 2026.
Yeah, see you in a couple weeks.
All right, see ya.
Okay.